and thank you all for your patience. So we were about to hit the last paragraph in the disclaimer where I acknowledge the value of my subscription to Tax Notes today. That's the primary source of information. That's my daily reader to keep up with what's going on in the world of federal and South Carolina income taxation. The feds are a lot busier than the state, and we have items of interest for federal update on a regular basis. South Carolina items of interest sometimes will already be picked up on the SCAPA website. Others we find, as we did this one for today, that may have limited interest. But if you have a client that is a micro distiller and you want to get the sales and use tax returns correct, this is the place for you today. It's been a busy week. We have 11 items to talk about. South Carolina liquor by the drink tax revenue ruling. We don't see those very often. Another disclosure form for the largest corporate taxpayers, which is really important if you're a decision maker in the tax department of a multinational corporation. It's an important disclosure form. A $4 million dispute we're reporting this week focused on at-risk basis. And it's important. It's an important technical lesson for all of us this week. And then number 4, seriously, the software fooled the taxpayer, gave them a $2.1 million deduction for their home mortgage interest. We can talk about that for all it needs. Another win for careful planning with split dollar life insurance. I was intrigued by how it worked. You may be as well. And then a warning, do not ignore letter 1153. What is that letter? I'll tell you. Answer cryptocurrency questions on another form, 14457, because it's been revised again, and the IRS is exhibiting a heightened interest in all sorts of cryptocurrency, virtual currency transactions, along with the proliferation of virtual currencies. It isn't all just about Bitcoin or Ethereum anymore. There are over 100 different blockchain focused or blockchain controlled cryptocurrencies in the world from which you can select. Some are industry specific, some are specific to a company and its dealer network. We'll talk about that a little bit more. A fact sheet on earned income tax credit for 2021 was announced, and a tax court judge determined the reasonable compensation for a contractor. I know that if you have a C corporation client that's making a lot of money, you're really going to be interested in this one. Then a listed transaction notice. According to the court, that notice violated the Administrative Procedures Act, the APA, and therefore any fines, penalties collected on the basis of that notice must be returned to this specific taxpayer. But what about you? If your client paid a penalty for violating this particular transaction, we'll talk about what that is, can you get a refund as well? And then finally, our last item this week, 2 fact sheets on qualified sick and family leave in 2 different time periods under 2 different statutes, just to make our lives interesting. If you have questions, please post them in chat. I try to watch the chat warning. I know Catherine and Whitney help me out with that, watching our questions that are posted in chat. A new law in 2021 on liquor by the drink tax in South Carolina. This is not liquor by the drink. It's a sales and use tax, but it applies to the shot glass. It applies to micro distillers that are conducting tastings and tours. 4 questions and answers and 2 examples. The liquor by the drink tax does not apply to the charge for a tour of the facility, but a sales tax applies to the fair market value of liquor given away. And it goes further with 2 examples. A sales tax applies. A lot of these micro distillers sell shot glasses that have their name on them. Sales tax applies to the shot glass that's given away as if it were sold. And a use tax applies to the purchase price of those shot glasses if they are not sold. So one way or another, the micro distillery is going to pay sales or use tax on the shot glasses that it either gives away or sells in connection with offering tours to the public. Large corporate taxpayers and the IRS each, both, all of them, want and benefit from disclosures to avoid penalties. New Form 15307, which I could not find, and no member of the tax team has been able to find it. But as of March the 7th, the IRS has told us what it is, but we can't find it. It is replacing the continuous audit program that we've been working with since 1994. Some form of that disclosure is required and will continue to be appropriate. The IRS is going to standardize the process for making disclosures of tax positions by large corporations so that the corporation and the IRS can engage in providing information, sharing their view of the law, and hopefully avoiding significant assessments, wasting time, and clogging up the court system. Here we have a partner's basis and at-risk amounts are affected by distributions to other partners and gain recognized in a prior year. I put that headline in bold type because I want us all to think about it for just a minute. The partner's basis in a transaction now is affected by distributions to other partners. In this case, it was repayment of a loan, which is treated as a distribution, and gain recognized in a prior year. The citation is CIRC, LLC. A distribution of over $15 million was made to a partner of CIRC in 2016. That triggered a corresponding gain at the partner level, and the partnership, following the law, increased the inside basis of its assets by the amount of the distribution because it had a 754 election in effect, and the election was required by Code Section 734B. Now, don't turn me off. I'm not going to just shatter code sections. We're going to come to the practical reality of this thing. The transaction was adjusted by the IRS, however, for events in 2014 and 2015. Now, wait a minute. This is a distribution in 2016. How can it be affected by what happened in 2014? We're about to come to the real lesson here. If a Section 754 election is in effect that allows the partnership to adjust the basis of partnership assets when there's a transfer of a partnership interest, the partnership can increase the adjusted basis of partnership property. But in this case, the entry that the partnership made back in 2014 affected the basis of the partners in 2016. Well, wait a second. 2014 was a closed year. Yeah, you're right. It was a closed year for adjusting income, but it was not a closed year for adjusting the partnership's determination of adjustments to basis. How the basis was affected in 2014 or 15 is taken into consideration in connection with the distribution in 2016 and 17. And even though the statute is closed, not allowing the IRS to change the income recognized for 2014 and 2015, the statute does not close the opportunity for the IRS to make adjustments to the partner's basis. And that's an important thing for all of us to understand when we're working with partnerships and some of the complexities that arise in accounting for partnership tax accounting for partnership interests and sales and exchanges and distributions of partnership interests. The headline for the next one is, "Are you kidding me?" Candace Bush and her husband appeared pro se, and all they got was a written summary of the judge's order from the bench. They're liable for an addition to tax and an accuracy-related penalty for failure to review their return. there is no, quote, reasonable cause for missing their software's decimal failure. They entered 21,000, 21000, but their software made that 2.1 million, and of course, eliminated their tax liability. This was the only appropriate artwork I could find in clip art. Now, a very well thought out use of split dollar life insurance. This is the estate of Mary Levine. She had a framework of trusts. She was well served by her attorneys and her CPAs. Split dollar life insurance here offers unique financial planning opportunities because you can separate the ownership of the policy, the life of the insured, and the financial benefits of the policy, and those can be owned by or three different individuals or entities. The insured person doesn't have to own the policy or have any financial interest in it. A secured debt interest can be granted to the person who pays the premiums. I'll pay the premiums on your life insurance policy, but I get to collect the premiums I paid sometime in the future when you die or if we cancel the policy. Any cash value above the amount that I loaned could be payable to still another party. So you can have four parties with an interest, either financial interest or a life interest in that life insurance policy. And that's what happened here. As part of her estate planning, Ms. Levine entered into a split dollar life insurance arrangement in which her revocable trust paid premiums for life insurance policies on the lives of her daughter and son-in-law. Now, the revocable trust is a disregarded entity. Not particularly important here. It was essentially the same as if Ms. Levine had made those payments, but she did not. And she wanted any money that might come back her way to come back to the revocable trust in the event that she predeceased the daughter and the son-in-law. When the arrangements terminated by their terms, and they didn't terminate, by the way, but when the arrangements terminated, the revocable trust had the right to be paid the greater of the premiums paid or the cash surrender value of the policies at that time. A irrevocable life insurance trust was the owner of the life insurance policies, and her grandchildren were the beneficiaries. So the insured lives had no financial interest in the financial portions of the split dollar arrangement. This opinion was written by Tax Court Judge Holmes, who has a great way with words, an interesting read for anyone that is concerned about the tax ramifications of split dollar life insurance. $6.2 million here is the cash surrender value that was not includable in Ms. Levine's estate. She had no right to prematurely terminate the underlying life insurance policies. Nobody had died. The policies had not matured. She was not the insured. And while she would get this money sometime in the future, she had no right to it now, and therefore it could not be included in her estate. Her death was not a realization event. Now, this is a perfect use of split dollar life insurance in a tax plan for an older taxpayer with a lot of net worth. Did you or your client get a letter from the IRS with a time requirement? If you did, do it now. What is a letter 1153 anyway? Well, from a web search, I was able to learn that the IRS uses letter 1153 to propose assessment of the trust fund recovery penalty against responsible persons. So if your client got a letter 1153, it's because the IRS has audited their payroll compliance and determined that there's an underpayment of taxes withheld from the employees, and that your client is the person responsible or one of the people responsible for making the payments. So the IRS is going to come after anyone and everyone who had any control over the business. The trust fund recovery penalty is the tax that you purportedly withheld from your employee's wages, the federal income tax withholding. Now, if you get if somebody gets a letter 1153, an appeal must be filed within 60 days. The letter says right there, 60 days. Right there. To preserve your appeal rights, you need to mail us your written appeal within 60 days. But wait, there's another time requirement here. Read the paragraph up here. Contact the person named at the top of this letter within 10 days. For what? For an informal try at resolving the matter. So you've got a 10-day window before you even have to worry about the 60 days. If you can get the case resolved in 10 days, it means that it's unlikely that you're going to have to hire counsel and go to court and try to argue that you're not the responsible person, and therefore you don't have to make the payment. Bookkeepers get caught here. Part-time accountants that were just keeping track of the payroll get trapped, and they get the letter 1153, and they don't have any money. They didn't really make any decisions, but both time limits. Muhammad Kazmi didn't pay any attention to either time limit, and therefore he could not challenge the assessment. He had an opportunity, he didn't do it, and so he can't challenge the assessment in a collection due process hearing. Now, in a collection due process hearing, you can work out an arrangement to pay the liability. But without the collection due process hearing and working out an arrangement with an IRS collection officer, your only out is to pay the assessment. Cryptocurrency reporting again. Week after week, we get a headline that requires us to talk about cryptocurrency. This week is no different. A still newer Form 14457 in the last week. This is the second revision because the IRS is treating cryptocurrency as an evolving program. Even if you appreciate the prominence of cryptocurrency questions on the updated voluntary disclosure form, you should be concerned about IRS motives and what they plan to do with the information they collect. In any event, make sure you answer the cryptocurrency questions on the Form 14457 and make sure that you answer all, and they're all in one place now. Make sure that you answer the cryptocurrency questions in your Form 1040. Not answering the question is the same as a wrong answer. The Earned Income Tax Credit Fact Sheet 2022-14 addresses the Earned Income Tax Credit for changes in 2021 to eligibility. It expands the credit and tells you how you can claim the credit on your 2021 returns. That's great. Where do I find the fact sheet? Right here. Go to irs.gov, newsroom, fact-sheets. They're all listed there in ascending chronological order. That is, the most recent fact sheet to be published on any subject is at the top of the list. When you go to that link, and you just work your way down until you find the fact sheet with the number and the content that is of interest to you. Our next item is a C corporation shareholders compensation adjusted. We don't see very many of these. We haven't seen them in a while because of the differences in tax rates. The corporate tax rate, the individual tax rate, the tax that would be paid on dividends, a reluctance of closely held corporations to pay dividends gets the IRS's attention. And they know these cases are really hard to win. And so they don't start up on these very often. And when they do, it's because they've got a pretty solid argument, and the taxpayer is well served to just fold their hand and pay whatever the IRS wants and move on. This is Clary Hood. His business was earth moving. He grew up in the business. His father started the company. Clary understood how to move dirt. He bought bulldozers and earth moving equipment and maintained that equipment. And at one point was doing a lot of work for Walmart stores. Came to realize, it was making a lot of money, by the way, several $1 million a year. Came to realize that he was getting a lot of price pressure from Walmart stores because they knew that they were his sole customer and there were other bidders coming in. So that work was less profitable all the time. And so he made an executive decision to change where his company went to look for work and found that they could get work that was very profitable. They were getting margins of 40% on dirt moving contracts. That's remarkable. Very rarely does that happen. But this company was able to make it happen because he knew the business. They paid him a $5 million bonus. Let's just keep the facts as simple as we can. But they failed to establish, and they deducted that, but they didn't establish how that amount was reasonable and paid solely as compensation for his services to the company during the review period. And that's underlined. You got one word that's bold, and you got another phrase that's underlined. Those are really important, both reasonable and solely as compensation for his services during the review period. And I would break that sentence apart because I would look for solely as compensation for his services at any time, because what the IRS is concerned about is a disguised distribution. This company was making a lot of money. It should have paid a dividend to its shareholders. Well, now, wait a minute. This guy owns his business. He makes decisions for the business. The IRS doesn't own any business. There are no people working for the IRS that are super successful business people. What do they know? That's the argument that is often used. So the taxpayer trotted in a couple of experts. The IRS brought in a couple of experts. The court heard the testimony of all the experts. And after hearing all that testimony, the judge concluded, this case will be appealable. Whatever decision I make will be appealable to the Fourth Circuit. The Fourth Circuit imposes what's called a multi-factor approach. The compensation history, compensation paid to other executives, the employee's qualifications and the complexity of the job, and distributions to shareholders, distributions paid, were only three of the multi-factors that would be considered when this decision was appealed to the Fourth Circuit. The court also observed that it might apply the independent investor test, which has been accepted by several federal circuits. Would an independent investor have paid this executive that kind of money in this period for that performance? Here, the court determined the amount the company could claim under Section 162A1. What is that? 162A1. That's the reasonable compensation statute. You can deduct reasonable compensation. That's Section 162 for 2 years, and held the company liable for an accuracy-related penalty for one of those years because they should have known better. So, when we counsel clients, we're not always just looking at what the tax liability might be, but if the IRS prevails, you're going to have a tax liability and an accuracy-related penalty. None of us want to be responsible for that. Next, alphabet soup. The IRS violated the APA. All these acronyms and these alphabetic representations of words week after week. It's mind-numbing. Just alphabet soup. And as I prepared this slide, I wrote IRS violated the APA. I thought alphabet soup, and I found that illustration. Notice 2007-83 is not valid not enforceable. We don't usually think about notices from 2007 in a 2022 tax update, but we're going to do that this week. Mann Construction resisted the IRS's assessment of penalties because it failed to disclose its participation in a cash value life insurance employee benefit plan. Now, those cash value life insurance employee benefit plans were virtually always tax scams. They were set up to take advantage of the tax law and produce a result that the tax law never imagined and never anticipated. So the cash value life insurance employee benefit plan shelter relied on an unintended application of federal tax law. So the IRS was in a panic. They were getting burned in every corner, and they wrote Notice 2007-83 and published that, trying to terrorize the taxpayers. But they forgot an important step. The Administrative Procedures Act requires the IRS to have those things blessed by Congress. Didn't happen. So the judge didn't even have to rule on whether the scheme was an abusive transaction. That wasn't the issue. The truth was, and I was involved in appealing the IRS's adjustments to several of these plans. They failed to satisfy the requirements for an employee benefit plan, and the taxpayers were heavily penalized for their participation. So what does that mean to you anyway? Well, probably nothing, unless you paid a penalty for failing to disclose participation in one of those plans. Or maybe unless right now you're engaged in litigation with the IRS on the issue of reporting required for participation in some other tax shelter transaction. Did the IRS follow all of the procedures mandated by the Administrative Procedures Act, or did they try a shortcut? And because they tried a shortcut, they cannot assess a penalty against you, even though you deserve the penalty. You're trying to take advantage of a tax scheme that is clearly abusive. You should be penalized, but the IRS can't penalize you because they failed to connect all the dots. These shelters were often addressed in separate notices. So in working to defend your taxpayer who is under attack for participating in a tax shelter, one of the things that you want to examine is whether or not the IRS's self-granted authority was in fact shared with Congress, and the procedures of the Administrative Procedures Act were followed. Oh yeah, 2 different tax credits. Here is a common symbol of heraldry. I couldn't find 2 lions, but I found 2 pussycats, and I put them to work here, holding up one side of this tax credits for paid leave. This couldn't be any more complicated. As you know, as many of you know, I do answer your questions that you put in chat and in SCAPA Connect, and we get questions regularly about this particular topic, tax credits for paid leave. Before April 1st, 2021, you had one law, one set of rules. After March 31st, different law, very similar rules. How's that even possible? Well, I'm going to give you a link again. I understand you can ask for a copy of the slides. The link will be there. So this is Fact Sheet 2022, 15 and 16. 16 tells you what you need to know. It answers frequently asked questions. There are about 100 FAQs in each one of these, but 16 is about prior to April 1st, 2021, and 15 is after. You'd think that the order would have been reversed, but it isn't. 2022-16 answers all of your questions about tax credits for paid leave under the Families First Coronavirus Response Act prior to April 1st, 2021. It includes a requirement to issue a corrected W-2 if credits were not claimed and sick leave wages were reported in box 14 of a Form W-2. And it also tells the self-employed person how to get the benefit of the credit. The same is true for 2022-15. It includes specific attention to reporting by self-employed individuals, but no attention to a corrected W-2. Could we continue to meet for lunch? Every week, Thursday at noon, this Zoom call will feature current developments from the preceding week and current developments in South Carolina state laws as well. We'll have guest experts from time to time. If you have a question, post it. Someone in the group may be able to help. I may be able to help. A guest presenter may be able to help. And if no one can help at that time, I will find an answer and get it back to you before the end of the week. What could be better? Questions about topics in my opening presentation will be answered in real time or in chat. If they require analysis of complex facts, we have to go to chat. And you can unmute and contribute to the discussion if you would like. That happens regularly. I encourage everyone to do that. Here's my contact information. You may feel free to contact me directly if that is best for you. And the response will be the same, accurate and timely. So until next time, please stay safe. We need each other.